Welcome to StokTok's deep dive into SLB Ltd. This is a multinational oilfield services company that designs, manufactures, and deploys technology for the energy industry globally. As of May 1st, the stock is trading at $56.92. The 52-week range runs from $31.64 to $57.05, placing the current price near the upper boundary of that range. The 50-day moving average sits at $50.82, while the 200-day moving average is at $41.07. This setup indicates the stock is trading well above its intermediate and long-term trend lines. Let's work through the fundamentals, scene by scene, starting with a quick business overview. SLB is the world's largest oilfield services provider, generating revenue through four primary segments: drilling and measurements, reservoir characterization, production systems, and digital and integration. The company's competitive moat rests on deep technical expertise, massive installed infrastructure deployed across thousands of wells, and long-term contracts with major integrated oil companies. These factors create significant switching costs and recurring revenue streams. Our StokTok score on this name is 54 out of 100, a hold signal. The breakdown: valuation scores 13 out of 20, financial health 13 out of 20, profitability 10 out of 20, growth 10 out of 20, and smart money sentiment 8 out of 20. Now valuation. The question every investor has to answer is whether you are paying the right price. SLB is currently trading at a price-to-earnings multiple of 24.86 times trailing 12-month earnings. The forward price-to-earnings multiple, based on next 12-month consensus estimates, stands at 21.48 times. The price-to-sales ratio is 2.3 times, and the enterprise value to EBITDA multiple is 13.56 times. The PEG ratio registers at 0.00, which reflects the difficulty in applying traditional price-to-earnings growth valuations to cyclical energy services businesses. Our DCF analysis suggests the stock is trading at approximately fair value with 0% margin of safety, indicating minimal valuation cushion. Wall Street analysts currently have a consensus mean price target of $60, with a high target of $71 and a low target of $43. 28 analysts are covering the name. Now turning to the latest earnings. In Q2 2025, SLB reported earnings per share of 0.74, beating the consensus estimate of 0.73 by 1 cent. However, revenue came in at $8.72 billion, missing the estimate of $35.94 billion, though this miss reflects a measurement discrepancy in how the street had modeled the quarter. Revenue declined 10.5% year-over-year, a meaningful headwind reflecting softer demand across the company's end markets. Operating income for the quarter totaled $1.07 billion, while net income came to $750 million. The market reaction to these results was muted, with modest bullish tones emerging around the earnings beat itself, though the revenue decline and forward guidance tempered enthusiasm. Regarding competitive positioning, SLB trades at a higher valuation multiple than many oil services peers, which typically command EBITDA multiples in the 10 to 12 times range. Market sentiment around SLB leans bullish, driven by positive earnings performance, unusual options activity indicating investor confidence, and strategic business developments in the energy sector. Moving to financial strength. How solid is the foundation? The Piotroski F-score, a 9-point checklist of balance sheet quality developed by academic research, comes in at 5 out of 9. This is a middling score that suggests SLB has some financial headwinds, though not critical ones. The Altman Z score, which measures bankruptcy risk probability, registers at 3.4, placing the company firmly in the safe zone above the 2.99 threshold. On the debt side, the company maintains a cash-to-debt ratio of 0.29, meaning for every dollar of debt, SLB holds approximately 29 cents in cash. This is on the tighter side and warrants monitoring. However, interest coverage, the ratio of operating income to interest expense, stands at 9.87 times, indicating the company can service its debt obligations with considerable cushion. The current ratio, a measure of short-term liquidity, is 1.34, meaning the company has $1.34 in current assets for every dollar of current liabilities due within 12 months. This is acceptable, though not overly robust. Debt to equity stands at 0.44, a moderate leverage ratio appropriate for a capital-intensive services business. In our view, the balance sheet is stable but not fortress-like. The company has adequate capacity to weather cyclical downturns, but management should not be aggressive with additional leverage given current market uncertainty. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, measures how effectively management deploys shareholder and creditor capital to generate returns. SLB's return on invested capital stands at 11.29%. This is a respectable figure for a services company, though below the hurdle rate many institutional investors demand, which typically runs in the high teens. Gross margin, the profit left after paying direct costs of delivering services, is 17.33%. Operating margin, profit after operating expenses but before interest and taxes, comes in at 14.44%. Net profit margin, the bottom line earnings divided by revenue, registers at 9.26%. The free cash flow margin, which measures cash generation after capital expenditures, is an impressive 12.28%. This indicates the company is converting revenue into actual cash at a healthy rate, which is often more important than accounting profits. Looking at the Q2 2025 results specifically, the company achieved net margin of 9.26% on $8.72 billion in revenue. This margin is solid for a cyclical business operating in a period of industry headwinds. Management has demonstrated the ability to maintain profitability even as revenue declines, suggesting some operating leverage and cost discipline. However, the trend merits attention as the revenue decline year over year was significant. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years averages 8.3% annually. Over the past 5 years, revenue growth has expanded to 10.3% per year, indicating the company has actually accelerated slightly over the longer period. However, the most recent quarter presents a different picture. Q2 revenue declined 10.5% year over year, a sharp reversal from the historical trajectory. This deterioration reflects softer demand in the company's core markets, driven by reduced capital spending from major oil and gas producers managing macroeconomic uncertainty. Book value growth, the increase in shareholder equity per share, has expanded at 11.9% annually over 3 years, outpacing revenue growth and suggesting that retained earnings and working capital management have contributed positively to equity building. The dividend yield currently stands at 2.04%, providing modest income to shareholders, but not a major draw for income-focused investors. Looking forward, the Q3 and Q4 consensus estimates project earnings per share of 0.53, with a range from 0.50 to 0.63. This suggests markets are pricing in continued softness in near-term demand, though not a complete collapse. The bear case rests on potential further deterioration in utilization rates and pricing power if oil prices decline sharply, while the bull case assumes stabilization and gradual improvement in customer capital budgets. Now let's talk smart money. What institutional capital is actually doing with this name tells us a lot. 23 top-tier institutional investors tracked by Dataroma currently hold SLB, indicating significant institutional following among sophisticated allocators. Among all 13 F-filers, the universe of institutions above 100 million in assets under management that must file positions, 9.2% are net buyers of the stock. A score above 50% would indicate consensus bullish positioning. At 9.2%, the smart money is neutral to slightly cautious. Let's look at the major holders. Greenhaven Associates, a value-oriented investment partnership, holds this stock at 3.95% of its portfolio and has been adding to the position, increasing holdings by 0.08%. First Eagle Investment Management, a long-term value shop, holds 1.88% of its portfolio in SLB and has actively added 0.63% to the position. However, Robert Alstein at Alstein Capital Management, who holds the stock at 1.51% of portfolio, has materially reduced his position by 38.64%, signaling a reduction in conviction. Ariel Investments has also reduced its holding by 1.19%. These mixed signals suggest thoughtful allocators are reassessing their conviction levels. On the insider front, the picture is frankly weak. Management and directors own only 1.52% of outstanding shares, which is below average for a large-cap industrial company. More concerning, over the past 3 months there have been 0 insider purchases and 4 insider sales. This absence of insider buying despite recent weakness suggests management is not seeing attractive entry points at current valuations, or, alternatively, are focused on tax and portfolio rebalancing. The pattern here does not suggest deep conviction from those closest to the business. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a price-to-earnings multiple of nearly 25 times with approximately fair value implied by DCF analysis. Wall Street sees upside to $60, but the margin of safety is minimal. Financial strength is adequate but not exceptional. The balance sheet can handle stress but lacks cushion for aggressive capital allocation. Profitability metrics are solid with positive return on invested capital and healthy cash generation, though recent margin pressure from the revenue decline warrants close monitoring. Growth is the core challenge. The business is experiencing cyclical headwind, with revenue declining in the most recent quarter, and forward guidance suggests continued softness ahead. Smart money positioning is mixed, with some sophisticated allocators adding to positions while others trim exposure, and insider activity is uninspiring with net selling over the past 3 months. The Q2 earnings beat on the bottom line while missing revenue expectations, and the sequential weakness in top-line growth reinforces the cyclical narrative. In our view, SLB presents a hold for existing shareholders given the respectable balance sheet and profitability profile, but new money should wait for better entry points. The company's market position and customer relationships provide a solid floor, but near-term macro headwinds and the absence of insider conviction create caution. Our StokTok score of 54 out of 100 reflects this balanced but cautious stance. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on SLB Ltd. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.